Hello with a question. What happens when your construction company has projects, your crews are busy, invoices are going out, but somehow the cash in the bank keeps getting tighter? That is one of the biggest challenges I see in construction. You can be busy and still struggle financially. You can have $1 million, $3 million, or even $10 million in revenue and still wonder, where is all the money going? The construction market changes quickly. Material prices change. Interest rates affect projects. Customers delay decisions. Payments arrive late. Labor costs increase. And sometimes one large customer suddenly stops sending work. Today, I want to talk about how construction business owners can protect themselves from those changes before they turn into a cash flow crisis. Sometimes people hear the words market change and immediately think about a recession, but that is not always what hurts a contractor. Small changes can create major financial pressure. Maybe materials increase 5%, maybe a project gets delayed 30 days, maybe your biggest customer reduces the amount of work they give you. Maybe three customers suddenly take 60 days instead of 30 days to pay. Individually, those things might seem manageable, but when several things happens at the same time, your profit can disappear very quickly. As of June 2026, Associated Builders and Contractors reported construction input prices were still 7.6% higher than 1 year earlier, even after prices declined during June. Why financial planning is so important? Imagine a contractor named Mike. Mike has a successful construction company. His company generates about $3 million per year. He has employees, he has equipment, he has several projects underway. From the outside, everything looks great. Then one of his biggest customers, responsible for almost 40% of his revenue, delays two projects. At the same time, another customer owes him $120,000. Payroll is still due Friday. Insurance still needs to be paid. Suppliers still want their money. Equipment payments do not stop. Mike's revenue did not disappear, but his cash flow suddenly became extremely uncomfortable. The real problem, Mike did not have a bad construction company. He had too much financial dependence concentrated in too physical few places. One of the first things I would look at as a CFO advisor is client concentration. Ask yourself, what percentage of my annual revenue comes from my largest customer? What about my top three customers? If one customer represents 30, 40, or 50% of your revenue, that customer has enormous influence over your financial future. Everything might feel great while the work is flowing, but if that customer changes contractors, loses funding, postpones construction, changes management, or simply starts paying slowly, your company immediately feels the impact. Revenue concentration is not just as sales issue, it is a financial risk. The solution is not to stop working with great customers. The solution is to avoid becoming dependent on them. For example, instead of depending heavily on one general contractor, you might build relationships with several. Instead of doing only new residential construction, perhaps there are opportunities in remodeling, tenant improvement, commercial work, maintenance, restoration, public work, or another segment that fits your capabilities. I'm not suggesting that you chase every type of construction project. Specialization is valuable, but there is a difference between specialization and financial dependence. Your financial reports should help you see exactly where your revenue is coming from. That is one of the conversations we have during financial analysis. Here is something very practical you can do. Run your revenue by customer for the last 12 months, then calculate what percentage each customer represents. Next, look at revenue by project type, then ask which customers are most profitable, which project types generate the strongest gross margin, which jobs consume the most cash, which customers consistently pay late, because more revenue is not always better revenue. I would rather see a contractor take a $200,000 project during a healthy margin, producing a healthy margin and predictable cash flow than a $500,000 project that constantly requires the owner to finance the customer. Another major source of financial pressure is how the contractor bills. Construction companies have many possible billing structures. You might use deposits, mobilization payments, progress billing, milestone billing, time and materials, cost plus, fixed price contracts, service agreements, recurring maintenance agreements. The right structure depends on the type of work you perform. The important question is, does your billing structure support your cash flow? Or are you financing the project for your customer? That distinction can completely change the financial health of your company. Imagine you have a $300,000 project. Before receiving enough money from the customer, you spend $40,000 on materials, $25,000 on payroll, $10,000 on subcontractors, $5,000 on equipment and other job cost. You have already put $80,000 into the project, but perhaps you have only collected $30,000. Where does the remaining $50,000 come from? Your bank account, your line of credit, your credit cards, or money from another project. That is where contractors get trapped. A profitable job can still create a cash flow problem if the timing of billing and collections is wrong. This is why your contracts and billing procedures matter. Depending on the project and applicable contract requirements, you may be able to structure billing around meaningful milestones. For example, deposit or mobilization, material procurement, completion of a defined phase, progress billing based on percentage completed, substantial completion, final completion. The objective is simple. Try to align incoming cash with outgoing project expenses. For recurring service or maintenance work, a monthly service agreement may create another predictable source of revenue. We are not trying to create complicated billing, we are trying to make cash flow more predictable. Now we come to one of the biggest construction cash flow problems, getting paid. You completed the work, you submitted the invoice, you recorded revenue, your income statement looks profitable, but the customer has not paid you. According to Build's 2025 National Subcontractor Market Report, subcontractors surveyed waited an average of 54 days after submitting a pay application to receive payment, and 74% reported generally being paid slowly by general contractors. Out that your accounting system can show profit while your bank account tells a completely different story. That is why I tell contractors profit and cash are related, but they are not the same thing. Do not just send invoices and hope someone pays. Create a collection process. Review accounts receivable every week. Look at current invoices. Invoices over 30 days, invoices over 60 days, invoices over 90 days, retainage outstanding, unapproved change orders, disputed invoices, missing documentation, then assign responsibility. Who follows up? When do they follow up? Was the invoice actually received? Is a lien waiver missing? Is the pay application incomplete? Is the project manager waiting for approval? Sometimes $100,000 is sitting in accounts receivable because nobody has a systematic process for collecting it. Market changes become dangerous when contractors discover problems too late. Suppose you estimated a job would generate a 25% gross margin. 3 months later, materials increased, labor hours exceeded the estimate, a change order was never billed, rework occurred, subcontractor cost increased. Suddenly, that 25% expected margin becomes 15%. If you discover that after the project is finished, there is very little you can do. But if we see it while the project is only 40% complete, management may still have options. That is why job costing and work in progress reporting are so important. We want financial information that helps you make decisions while there is still time to make them. Here is another tool I believe every growing contractor should have: a rolling cash flow forecast. Not just how much money do we have today, but what cash do we expect to collect next week? What payroll is coming? What materials need to be purchased? What subcontractors need to be paid? What loan payments are due? What taxes are coming? What large receivables are outstanding? What happens if a $100,000 payment arrives 30 days late? Once you can see several weeks or months ahead, you stop managing the company through the bank balance. You start managing it through information. That is completely different way of running a business. This is where our role goes beyond bookkeeping. Bookkeeping tells us what happened. CFO advisory helps us decide what should happen next. We can review your job profitability, your gross margins, your accounts receivables, your client concentration, your cash flow, your work in progress, your billing structure, your budgets, your forecast, your overhead, your financial trends. Then we can sit with the business owner and ask, where are we losing money? Where is cash getting stuck? Which projects are actually profitable? Which customers are creating financial risk? Can we improve billing? Can we improve collections? Can we reduce unnecessary expenses? Can we make a better decision today instead of discovering the problem 6 months from now? That is where financial information becomes valuable. Let me leave you with this. You cannot control the entire construction market. You cannot control interest rates. You cannot completely control material prices. You cannot control what customers decide to build. And you cannot prevent any project delay. But you can control how you prepare. You can diversify your customers. You can understand your job margins. You can improve billing. You can aggressively manage collections. You can forecast cash. You can monitor work in progress. And you can make decisions using accurate financial information. The market may change, but your business does not have to become financially vulnerable every time it does. If you own a construction company and you are making money but still feel like cash is tighter than it should be, I would be happy to sit down with you for a profit and cash flow analysis. We can look at your numbers together and identify where money may be leaking out of the business and where opportunities may exist to improve profitability and cash flow. In the right situation, those improvements can potentially be worth $25,000, $200,000 or more per year. Of course, every business is different and results depends on the facts. The goal is not simply to do more construction projects. The goal is to build a construction business that produces stronger profit, healthier cash flow, and greater financial stability. Thank you for joining me today. I'm Nilesh Shah, accountant and CFO advisor. And remember, revenue makes you busy, profit makes the business worthwhile, but cash keeps the door open. Thank you. Have a great day. Happy weekend.